They told you it was a gift. They told you it was a reward, a warrior dividend, a patriotic bonus to honor the nation's founding. But if you were watching the bond market the moment those checks hit the mail, you realized immediately it wasn't a gift. It was a signal. Because money doesn't move in headlines. It moves in panic. And while the cameras were focused on the White House, the smartest money on earth was doing something very different. It was buying the one asset the government cannot print. On December 17th, the administration announced a one-time tax-free payment of $1,176 to nearly 1.45 million military service members. The headline was perfect. Tariff money going back to the heroes. America first. Win-win. No downside. But markets don't care about patriotism. They care about flows. And while the public saw generosity, the bond market saw something else entirely. Because that money didn't come from savings. It came from tariffs. And tariffs don't behave the way politicians say they do. In the same week that money was promised, something snapped in the silver market. Between December 4th and December 8th, 47.6 million ounces of silver were pulled out of COMEX vaults. Let that sink in. 47 million ounces. That's 60% of the entire registered inventory gone in 96 hours. This wasn't volatility. This wasn't a correction. This was a bank run. The bullion banks, the same entities that have controlled silver pricing for decades, lost control of the physical metal. And once that happens, paper prices stop mattering. To understand why silver exploded, you have to understand why the dollar started wobbling. Most people look at the stock market to judge the economy. That's a mistake. The truth lives in the bond market. And right now, the bond market is screaming. Earlier this month, President Trump signed what he called the One Big Beautiful Bill. Aggressive tariffs on China, on Mexico, on Canada. Politically, it's sold as strength. Economically, it creates a dangerous feedback loop because a tariff is not a penalty on foreign countries. It's a tax on consumption. Prices go up, inflation rises. Normally, governments use that revenue to reduce debt, cooling the system. But this time, they did the opposite. Instead of removing money from the system, they injected it directly back into households. $1,176 checks, right before Christmas. That is high-velocity money. You raise prices with tariffs, then print money so people can afford those prices. The result is predictable. Inflation re-accelerates. The CPI curls upward. The dollar weakens. And capital does what it has always done throughout history. It runs. Gold hit $4,400. That made headlines. But silver? Silver moved like a tech stock, up 130% in 1 year. Because silver isn't just a hedge, it's a supply chain bet. For 40 years, silver prices were set by paper, promises, contracts, rehypothecation. The same bar sold to 10 different buyers. It worked, as long as nobody asked for delivery. But on December 4th, the bluff was called. That day, holders of 7,330 contracts stood for delivery. They didn't want cash, they didn't want a roll, they wanted the metal. That's 36 million ounces demanded in one trading session. 30% of the exchange's free float in 1 day. And here's the problem. The silver wasn't there. What followed was one of the most important signals in commodities, backwardation. In a normal market, future prices are higher than spot prices. That's contango. But in December, that flipped. Traders were paying premiums of up to $3,000 per contract just to jump the delivery line. That's not speculation, that's fear. That's the market saying, we do not trust this system to deliver metal in January. And when the pricing mechanism loses credibility, price discovery breaks. If COMEX can't deliver, it can't set the price. If contracts are settled in cash, paper silver and physical silver divorce, you could see $70 on a screen and $150 at a coin shop. And once that gap opens, it never closes quietly. So where's the silver going? East. While Western investors were distracted, China was draining metal, leasing silver, standing for delivery, shipping it to Shanghai, what analysts call a hurt and rescue strategy. Bleed the system slowly, then buy when it breaks. Even now, Shanghai inventories are at their lowest level since 2016, but China isn't selling. They're hoarding. Because they understand something Wall Street doesn't. The green vortex. Silver supply isn't flexible. Most silver is a byproduct. And one of the world's largest sources just went offline. The Grasberg mine in Indonesia, September 24th. Force majeure, flooding, infrastructure failure. Hundreds of thousands of tons of copper concentrate gone. Millions of ounces of silver removed. This is not a rumor. The mine is down. Meanwhile, demand is exploding. Solar, EVs, AI data centers. Silver is essential, and that demand is inelastic. If silver doubles, factories don't stop. They pay, which turns price discovery into an auction. 10 buyers, 1 bar, no charts, just fear. Millions hold paper silver, ETFs, accounts, statements. But read the fine print. In a shortage, they settle in cash. You get depreciating dollars. They keep the metal. That's the wealth transfer. January is delivery month. The vaults are thin, the mines are down, the dollar is weak, the trigger has already been pulled. So I'll leave you with this. If you can't hold it, you don't own it. Ignore the price. Watch the vault. The 1,776 SAR check was just the bait. The real payout comes next.